In this section, we're going to talk about capital budgeting. So that's budgeting, how to invest our capital. And we are looking at future cash flows from investment, and we need to consider the time value of money. So first, let's get back to our basics on present value. Let's say I offer you $100 now and $100 a year later, and you're going to choose between the two. What are you going to choose? So Jay there, he says he wants it now. What if I say I'll give you $100 a year later, but if you want it now, I'll just give you $91. Then my friend Jay there, he is indifferent. He says anything is fine. So guys, what this means is the $91 that I'm ready to pay now is growing to $100 in 1 year. Guys, that is the concept of time value of money. So let me put it here. What we can say is $100 after a year is worth $91 today. Or in other words, the present value of $100 after 1 full year is $91 today. You could also say that the future value of $91 today is $100 after a year. Now, this is assuming a 10% interest rate. So let's look at the present value tables that we have on our book. So the present value of $1 at 10% after 1 year is 0.909, or let's say 0.91. So guys, you got how I calculated this number, $91? I multiplied the $100 after 1 year with this present value factor. Present value of $1 after 1 year at 10%. So $1 1 year later is worth 91 cents today. So $100 a year later would be worth $91 today. So let's do that for the second year. So how much is $100 after 2 years worth today? Or in other words, what is the present value of $100 coming in after 2 years at 10% interest rate? So we're looking at two things. We're looking at the time, the year 1 or year 2, and we're looking at the interest rate, 10%. So we're keeping it at 10% for now. So looking at that, we have 2 years, 10% gives us 0.826. We could say 0.83. So the present value factor for 2 years, 10% is 0.83. That's for $1. So you could say $1 coming in after 2 years is worth 83 cents today. So how much is $100 worth? So that's 100 into 0.83 gives us $83. Now let's go to the third year now. So now we're looking at year 3, and again let's keep it at $100. So how much is $100 coming in after 3 years worth today? So let's look at the worth of $1. So $1 would be worth 0.751, or let's say 0.75. So what we're saying is $1 coming in after 3 years is worth 75 cents coming in today. $100 after 3 years is worth $75 today. Now let's move on. Fourth year. Again, $100 coming in after 4 years, long years. The present value factor, so I'm looking at the 10% column and the 4-year row, and that is 0.683. 68 cents. So a dollar after 4 years, the present value of that dollar is 68 cents as of today. The present value of $100, that's going to be $68. Then if you look at year 5, another $100 coming in, and I want the present value number, which is 0.621, so 0.62, and that is worth $62 as of today. So guys, as you can see, What I've done is I've used the present value factors from the present value tables that you have on your book, and I have calculated the present value of money flowing in after a period of time. So present value of $100 flowing in after a year is worth $91 today. Present value of $100 flowing in after year 4 is worth $68 today. Looking at it the other way, the future value of $91 today is $100 after year 1. You could say the present value of $75 today is $100 after year 3. So guys, that is the concept of present value. We look at future cash flows, get it to present date. Future value, you look at current cash flows and you get them to future dates. Now, when I look at this cash flow, this is a periodic cash flow. Let's say $100 comes in after year 1 and it also comes in after year 2 and after year 3 and year 4 and year 5. We could call such cash flows annuities. So if I'm having such a consistent cash flows of $100 flowing in for the next 5 years, how much is that entire cash flow, that entire annuity worth today? So we've been doing that, right? So we did $91 for the first year, $100. $83 for the $100 that's coming in after year 2. $75 for the $100 that's coming in at year 3. $68 for year 4 and $62 for year 5. Now, if I sum all this, I'll get the worth of this entire cash flows as of today, the present value of all these cash flows. So let me sum it up. So 1 plus 3, 4, 4 plus 5, 9, 9, 17, 19, 9, 1 goes up, 10, 18, 25, 25, 31 and 37. So this gives me 379. So guys, if you don't remember all these calculations from school, you can use a calculator on your CP exams, don't worry. Now, so what I'm saying is these cash flows over 5 years is worth $379 as of today. So now, instead of doing all these calculations, 0.91, 0.983, 0.75, 0.68, 0.62, so that was present value of $1 after each year. I could have instead used a present value of annuity table. It's the same cash flow coming in every year. So if I use the present value of annuity table, so if you look at that, the present value of an ordinary annuity. So this annuity is coming in for how many years? 5 years. So I'm looking at the 5-year row. What's the rate of interest? 10%. So 5-year row, 10% column, and I get this number 3.79. So guys, it would have been so simple. Instead of doing all these calculations, I would have simply done $100 into 3.79 would have given me $379. Simple, easy. So guys, what you could say is the present value of ordinary annuity of $1 for 5 years at 10% is 3.79. So let me write it. The present value of ordinary annuity. Now, we're calling it ordinary annuity because the amount is coming in at the end of each year. Ordinary annuity, that's also called annuity in arrears. So guys, as you can understand, the money in year 1, it's coming in at the end of year 1, and that's why it's worth only $91 today. The money, $100 for year 2, it's coming in at the end of year 2. So ordinary annuity. Annuity in arrears, it comes after the year ends. So the present value of ordinary annuity of $1 at 10% interest for 5 years is 3.79, and this is something I've picked up from this present value of ordinary annuity table. Now I've picked up this 3.79 and I simply multiply it by $100 because $100, that is the same number coming in every period. So I get 379. Makes it simple and easy. So that was an ordinary annuity, annuity in arrears. Now how about if this amount, $100, is coming in at the beginning of each period? So let us say if this $100, instead of coming in at the end of year 1, comes in at the beginning of year 1. And let me use a blue pen for this. So if this comes in at the beginning of year 1, guys, what is the present value of $100 today? $100 today is worth $100. Simple, easy. A kid would say that. So the present value of $100, which is coming in at the beginning of year 1, is $100. So this is no longer 91, because in case of an ordinary annuity in arrears, we were looking at this $100 coming in after year 1, or rather when we did the present value 0.91, we looked at this $100 coming in after year 1. Now we're talking about a different annuity, annuity due or annuity in advance, where money is coming in at the beginning of the period. So if it is coming at the beginning of the period, this $100 is worth $100. Now when I look at the $100 coming in at the beginning of year 2, guys, just to distinguish, I'm using a blue pen. So beginning of year 2, guys, beginning of year 2, so the 1st January of second year is more or less the same as 31st December of year 1. So end of year 1 and the beginning of year 2 are sort of same. So you could say the $100 which is coming in at the beginning of year 2 is worth $91 today. You could also say the $100 that is coming in at the beginning of year 3 is worth $83 today, not 75, 83. 75 was when the $100 was coming at the end of year 3. Now this $100 is coming in at the beginning of year 3, so it's worth 83. $100 at the beginning of year 4 is worth 75. So beginning of year 4 is the same as ending of year 3. Beginning of year 5 is the same as ending of year 4, and it's worth $68 today. So guys, now if I look at this annuity in advance, so I would say the present value of annuity in advance or annuity due. So okay, this was annuity in arrears. This is annuity in advance. This was ordinary annuity. This was annuity due. And if you total that, so 91, so 1 plus 3, 4, 4 plus 5, 9, 9 and 8, 17, 7, 1 goes up, 10, 18, 25, 31, 3 goes up, 3 and 1, 4. $417. Or you could say, we could do this we've done this $100 into 1. The amount that's coming in on day 1, that's $100 into 1, plus $100 into present value of ordinary annuity for 4 years. Because guys, though this amount is coming at the beginning of year 2, that's same as end of year 1. Beginning of year 3, same as end of year 2. So we could look at the ordinary annuity for 4 years. So now if I look at the present value of ordinary annuity table for 4 years at 10%, I get 3.17. So it could be $100 into 1 plus $100 into 3.17. So that gives us $100 into 4.17 or $417. So you could say the present value of annuity due, not ordinary annuity, annuity due now of $1 at 10% interest for 5 years is 4.17. So 1 plus 3.17 gives me 4.17. So that is the concept of ordinary annuity versus annuity due. So we've looked at two things now. First, we've looked at present value of $1. So if we didn't have this entire cash flow, we just have this one number coming in. The present value of $100 after year 1 would have been $91. So that was basically when you have a single cash flow after a point in time. Or let's say we didn't have any of these cash flows, we just had $100 after 5 years, not beginning, end of 5 years. That would have been worth $62 today. So that would have been a present value of $1 after a certain period of time at a certain interest rate. So that was the present value concept. Then we started looking at annuities, a series of cash flows. Now because the series of cash flows are same numbers, what we did was, instead of calculating so many present values, we simply looked at the present value of ordinary annuity table. So when we had the series of cash flows coming in at the end of each period, we call it ordinary annuity or annuity in arrears. And we said $100 into 3.79, that was the number for $1 for 10% 5 years, and we calculated that's 379. If the annuity was for beginning of each period, so the money was flowing in the beginning of each period, then it was an annuity in advance or annuity due, and we said the $100 that's coming in at the beginning of year one, that's worth $100. But for the remaining cash flows, we will still use the present value of ordinary annuity table. So we used it instead of 5 years here, we used it for 4 years here, and we got 3.17. So 3.17 into 100 was $317 plus $100 gave us $417. That is present value of annuity in advance, annuity due $100, 5 years, 10%. So guys, you're looking at number of years and you're looking at the interest rate. On page 4, we have the time value of money. We're looking at present value and annuities. Highlight ordinary annuity, which is also called highlight annuity in arrears. Now, in this type of annuity, payments are made underline end of each period. Next, highlight annuity due and highlight annuity in advance. Now here, payments occur underline at the beginning of each period. Now, looking at the present value tables, put a box around present value of $1 and right there, use for single future cash flow. Put a box around present value of an ordinary annuity and right there, use for stream of future cash flows. Move to page 5, where we're looking at the present value tables. So looking at the present value of $1 table under the 10% column. So present value of $1 after 1 year at 10% discount rate is highlight 0.909. Present value of $1 after 2 years at 10% discount rate is highlight 0.826. Present value of $1 after 3 years at 10% discount rate is highlight 0.751. Now let's look at the present value of an ordinary annuity table. So again, ordinary annuity, if it's only for 1 year, that means a single cash flow at 10%, it's 0.909. But if it's 2 years, in that case, it is 0.909 plus 0.826, highlight 1.736. If it's present value of an ordinary annuity for 3 years, $1 at 10%, then it's highlight 2.487, which is equal to 0.909 plus 0.826 plus 0.751. On the second sub-bullet, they put a box around present value of annuity due. So here we are looking at annuity in advance. The payments occur at the beginning of each period. So right there, number 1 on ordinary annuity table, look at present value factor for n-1 periods. And right, number 2, to the above present value factor, add 1. So looking at a sample calculation that we have here, highlight present value of annuity due at 10% for 3 years equals present value of ordinary annuity at 10% for 2 years, n-1 years, plus 1. So the present value of ordinary annuity at 10% for 2 years, that's 1.736. When you do plus 1, that gives you present value of annuity due at 10% for 3 years, which is 2.736. In this section, we're looking at capital budgeting. We're talking about budgets relating to long-term investments. Now, an entity may have many alternatives long-term investments, many projects where they could invest in. So the objective of capital budgeting is to decide whether or not to accept an alternative, or it's to identify which are the best investment alternatives. Now we're going to evaluate the alternatives or projects using discounted cash flow techniques. Basically, you're looking at evaluation of an investment today versus present value of future cash returns from the investment. So guys, I got a template in here. In real life, we do Excel modeling for this. I have a very simple template which talks all about how to model a discounted cash flow for capital budgeting. So let us say we're looking at initial cash flows, where you have your initial investment in the project. So that's a cash outflow. You need to give out cash, shell out cash for that. So cash is negative here. Now, often when you start up a long-term project, long-term investment, you need more working capital for that project, for that alternative. So it calls for an increase in working capital. Again, that's a cash outflow. Now, assuming all this happens on day one, so right on day one, you purchase some equipment, some machinery, you increase your working capital, you start up on this long-term project, which you think the life is going to be 5 years. So you're going to run the equipment, run the project for 5 years, and after that, you're going to dispose it off. So you're going to have cash flows from operations for the next 5 years that the alternative, the project is ongoing. And guys, we're looking at cash flows here, not accounting income. So you got accounting income, but I'm looking at cash flows. I'll come back to this. So let's say for all the 5 years, we're going to have cash coming in. So year 1, we had some cash. Year 2, we are having some cash. Year 3, some cash in. Year 4 and year 5. At the end of year 5, we want to sell off all the assets that we have on this project. So when we sell off assets, we're going to get something, we're going to get some salvage value, let's say. So that's going to be terminal cash flows that we're going to receive. Maybe this working capital, which was increased earlier initially, would later be recovered because after the project is no more, you don't need that excess working capital. So let's say even that is recovered. So as you can understand, we're looking at cash outflows and we're looking at cash inflows. Now we're going to use the time value of money, present value, get everything right to today. So we're going to compare this investment, the present value of cash outflows versus the present value of all the cash inflows that's going to come in across years. And we're going to compare, should we accept or should we reject? If we got multiple alternatives, we got to decide which is the best alternative we should go for. Now, as I told you, a very important consideration here is we are not looking at accounting profit, we're looking at cash flows. So let's look at an example book. So let me put all the numbers for year 1 here. Let's say sales is $1,000. Then you have costs, and look at this, costs other than depreciation, interest and taxes. So generally in COGS and SG&A, you have depreciation, right? So in cost of goods sold, you do have depreciation for factory equipment, factory buildings. So that's cost of goods sold. Let's say it's depreciation of delivery trucks or depreciation of the administrative block. That goes into SG&A. But what we are saying is for the purpose of cash flows, we'll keep depreciation aside because depreciation is not a cash outflow. Cash doesn't go out when you depreciate. It's a non-cash expense. So if sales are $1,000 and costs other than depreciation, interest and taxes are $600. So this plus this is $600. This is other than depreciation. This gives us EBITDA. Now EBITDA stands for earnings before interest, taxes, depreciation and amortization. Basically interest, taxes, depreciation. So this one, let's say, is $400. EBITDA is $400. Then you have depreciation and amortization. So in this example, let's say it's $100 of depreciation. That gives you EBIT. EBIT stands for earnings before interest and taxes. So that calculates to 400 minus 100, 300. Then you have interest. Interest is $50. This gets you to earnings before taxes, which is $250. Then you have less taxes. So let's say the tax rate is 30%. So 30% of $250, that's $75, gets you to earnings after tax, which is $175. So this is your accounting profit, your net income. Now what you do is you add back this depreciation and amortization. So you subtracted, but I said cash never went out. So we add it back here, which gets us to the cash flow number of 275. Guys, understand? So we started with sales. We looked at costs other than depreciation, interest and taxes, because depreciation went off here, interest went off here, taxes went off here. So these costs, these are other than depreciation, interest and taxes. So sales less these costs, that gives us EBITDA. EBITDA less depreciation and an amortization gives us EBIT. EBIT less interest gets us to earnings before taxes, less taxes, earnings after taxes, your net income, accounting income. But to that, we've added back depreciation and amortization. So I can see somebody asking, somebody looking at me so keenly, if we had to subtract and then add it back, why subtract depreciation at all? Well, that's a valid question. So let's do the numbers again by getting depreciation totally off our schedule. So I'll do it here. So let's say I'm looking at sales $1,000, less costs $600, $400 of EBITDA. And somebody said, you're subtracting depreciation here, adding it back here. Get this off the schedule. So let's forget depreciation. Let's look at what happens. Interest 50. So I'm not subtracting depreciation because there's no point subtracting and adding it back. Somebody said so. So that gets me to earnings before taxes of 350. Now we're going to have taxes on 350 at 30%. What's that? So that's 30, 60, 90, 105. That gets us to earnings after tax of 245. Now we didn't subtract depreciation here, so we won't add it back. So here we got the cash flow number as 275. But here we just got 245. What's the difference? Guys, the depreciation that you had subtracted here provided you with a tax shield, a tax benefit. Look at this. You calculated 30%, this number. Now this number was reduced for depreciation. So depreciation reduction here provided you with a tax benefit. But here we didn't do that. So if we consider the tax benefit out of depreciation, so $100 of an expense allowed for tax purposes, 30% is the tax rate. What's the tax benefit out of this depreciation? $30. So now to this 245, if you add 30, you get to 275, which is the same number as we have right here. So I would not recommend going for this method. I really love this way of doing it. The way we subtract depreciation and amortization first, then calculate what's the taxes, add back depreciation. So this depreciation provides us with a tax shield here. So use the tax shield, add back depreciation, amortization, get to your cash flows. So guys, capital budgeting, we are focusing on cash flows, not accounting income. We're looking at the initial cash flows, what's gone out in the beginning. You could have cash outflows also later, but generally on your exams, you're going to have initial cash outflows. Then you're looking at what's cash coming in. So you've started the project, you're earning money on that, getting in cash flows across all the years. Finally, you might decide to terminate the project. So that'll be terminal cash flows. Put this all together, use a discount rate to calculate present value. Compare the present value of outflows with the present value of inflows. So I'm going to talk about net present value and IRR, or the internal rate of return. We'll also do a couple of more capital budgeting methods like payback period and accounting rate of return. But the most important ones are net present value and IRR. We're looking at calculating cash flows. Highlight cash flows equal accounting net income plus depreciation and amortization. So let's say we're starting with sales less costs other than depreciation, interest and taxes. This gets us to highlight EBITDA. Now EBITDA less highlight depreciation and amortization, highlight the negative $100, gives us highlight EBIT, earnings before interest and taxes. Less interest gives us highlight EBT, which is earnings before taxes. Then we less taxes gives us highlight EAT, earnings after tax. So that's your accounting income. Now to that we would highlight add depreciation and amortization $100, which gives us highlight cash flows. So the reason why we subtract depreciation and then add it back later is to avail of the depreciation tax shield, the tax savings that we have on account of depreciation. Now towards the bottom of the page, let's write exam tip. Right, look out for number 1, initial cash outflow. So here you're looking at investment plus increase in working capital minus any sale of existing assets. Number 2, then we're looking for cash flow from operations after tax. And right there, remember to adjust for the depreciation tax shield. You could very easily do it by subtracting depreciation before you calculate taxes, and after you calculate earnings after tax, add back depreciation. Then number 3, terminal cash inflows, and within brackets disposal of asset plus recovery of working capital. So basically we're looking at the initial cash outflow, the cash inflows from operations during the life of the project, and the terminal cash inflows. We're going to be looking at 4 techniques of capital budgeting. And let's start with an easy one, a simple one, payback period. So this is the time to recover the initial investment. So the question here is, what's the payback period? So basically we're looking at how much time does it take for us to recover this initial investment. Does it happen in 2 years, or it takes 3 years or 4 or 5 years to recover this initial amount? So we're looking at payback period. And if this stream of cash flows is even, that means it's the same dollar number each year, then we can use a formula that I'm giving you. So you can look at initial investment divided by the after tax net cash flow each year. So it's the same number for all the years. And this would give you the payback period in number of years. So we're looking at this as a starting point. So let's get the working capital thing off. So let's say we're looking at initial investment as a starting point. How much time does it take for us to recover this initial investment? Now, couple of quick questions for you. Are we using cash flows here, or we using accounting profit? No, we're using cash flows. I said cash flow, so that's good. Are we using time value of money? Are we discounting these cash flows or taking them at the number as they are? We're not doing any discounting, so we're not taking time value of money, which is a disadvantage here. Now, to cover up for this disadvantage, we're going to use discounted payback method. So instead of using payback period, we'll use discounted payback. So that's a modification here. Now, to understand this, let's look at an example on a book. So we're looking at assume an investment of $300 results in a return of $100 each in the first 5 years. So we're looking at a $300 investment which is getting in returns $100 each year for the first 5 years. 100, year 3 is 100, 4 is 100, 5 is 100. Now the question for you, how much time does it take to recover the initial investment? In 1 year, you've recovered 100. 2 years, 200. 3 years, yes, you're done in 3 years. So in 3 years, you've recovered the initial investment of $300. You can even put it up on my formula there. So initial investment amount, that's $300. After tax net cash flow, same number each year, $100. Number of years, 3 years. Simple, easy method, which gives a good starting point on how good the investment is. How much time does it take to get back the initial money that you've put in? Now, cash flows, yes, we've used cash flows. We didn't take depreciation in here. But time value, we haven't. So let us use discounted payback period here. So now what we will do is we'll start considering the time value of money. So we would say that $100 1 year later is worth less than $100 today. So we're going to use the present value factor. So it's given the interest rate is 10%. So we're going to use present value factor at 10%. So after 1 year, it's 0.909. 2 years, it's 0.826. 3 years, it's 0.751. And you got 0.683. So what's the present value of these cash flows? So present value of $100 coming in after 1 year is worth $91 today. Present value of $100 coming in after 2 years is worth $83 today. Present value of $100 coming in after 3 years worth $75 today. $100 after 4 years worth $68 today. Now let's do cumulative cash flows. Rather, cumulative present value of cash flows. So at the end of year 1, we're done with $91 of recovery, present value. At the end of year 2, we're done with 91 plus 83, that's $174 of recovery. End of year 3, we have 174 plus 75, $249 of cumulative present value. Have we recovered our initial investment of $300? Now, when we didn't do any discounting, the cumulative after 3 years was 100 plus 100 plus 100, $300. We were done. Payback period. But the moment we're doing discounted payback period, we are using the discount rates. And it's only $249. We haven't yet reached $300. So it'll be a little more than 3 years. So let's see how much. Let's look at what's happening at the end of 4th year. 249 plus 68, that's 317. That's more than 300. So we know that the recovery period under discounted payback would be somewhere in between here. Somewhere in between year 3 and year 4. So it's going to be a little more than 3 years, less than 4 years. Now, we are looking at when do we get $300 here. So let's try to use a fraction and calculate that. So we know discounted payback period in this case is 3 years. Plus, if I look at the 4th year, we are looking at recovery of 300 minus 249, $51 here. We're looking at 300 minus 249, basically we are looking at $51. The denominator is how much is the total recovery, total cash flows in the year. We're looking at the present value number, $68, or you could say 317 minus 249. So you could have 317 minus 249. That's basically $68 of cash flows in year 4. So in the entire year, we got $68 at present value for year 4. How much time, how much portion of the year did it take to get $51? So 17 into 3 is 51, 17 into 4 is 68. So it's 3 years plus 3/4 of a year. So 3.75 years. Or you could say 3 years and 9 months is the discounted payback period. So payback period, that was 3 years. We didn't use time value there. When we're doing discounted payback, we are using time value. So time value is a tick here. So that's a good thing about discounted payback. Now, so payback, discounted payback, pretty simple, pretty easy methods. Now, one big disadvantage that I see for both these methods is that they are only concerned about cash flows till the recovery of the initial investment. They're not bothered about cash flows after that. So in payback period here, we're not bothered about what happens after year 3. Or in discounted payback period here, we are not bothered about what happens after year 4. So it does not look at a comprehensive picture, just the recovery of the initial investment, just the payback period. We're looking at the payback period. Right there, cash flows, and put a tick mark because we use cash flows for payback period. Right, time value and put a cross because we don't use time value of money to calculate payback period. But right there, except if discounted payback. So it's only in discounted payback method that we use the time value of money. Then write simple and put a tick mark because this method is very simple. Now the first supplement there, underline, if the cash flow is the same every year, then we can use our formula, highlight initial investment divided by after tax net cash inflows. And put a circle around number of years. Highlight discounted payback method and highlight future cash inflows are discounted to the current investment date to calculate the payback. So as I said, discounted payback method, it does use time value of money. Now the next simple and easy technique for capital budgeting is accounting rate of return. Guys, I say the word accounting. So that means we're no longer talking about cash flows, we're talking about accounting profit or the accounting return on investment. So we don't use cash flows for this, we don't use no time value for this. So let's look at the formula quickly here. So you got accounting rate of return or ARR. Here we're looking at the accounting income or the net income earnings after tax, and we're going to divide it by the average investment. So you're looking at the investment at the beginning of the year, investment at the end of the year, divided by 2, you get the average investment for the year. So this gives you a rate of return which takes no cash flows, it takes accounting profit, it takes no time value of money. So it's a simple technique, a good ballpark number, good starting point. So these are all simple techniques that we've seen, and we'll come back, look at net present value and IRR. We have accounting rate of return on page 14. Right there, cash flows, and put a cross sign because we don't use cash flows for accounting rate of return. We use the accounting income. Next, right, time value, put another cross because we are not concerned with time value of money when we are calculating accounting rate of return. Right, simple and put a tick mark because calculating accounting rate of return is pretty simple. So here we are looking at, put a box around ROI or return on investment. The formula is highlight accounting income divided by average investment. So what's the return on the investment? Now for accounting income, put an equal sign and write cash flow minus depreciation. So we saw that accounting income plus depreciation give us cash flows. So cash flow minus depreciation would give us accounting income to calculate ARR or the accounting rate of return. Now we look at net present value technique of capital budgeting. So guys, net present value. That means we're looking at the present value of all the cash inflows and we'll net it off with the present value of the cash outflows. So let us say we're looking at cash inflows of $100 each year for the next 5 years, and we have a discount rate of 10%. The present value of this annuity is 3.79. So 100 into 3.79 gives us $379. So the present value of this cash flow stream at a 10% discount rate, we'll call it the hurdle rate, is $379. What's the present value of cash outflows? That's $300 going in right today. What's the net present value? $379 present value of cash inflows less the present value of cash outflows. So $379 minus $379. So the net present value in this case would be $79. And the moment the net present value is equal to or greater than 0, it's positive. That means we should accept the project, because this project is giving us more return than our hurdle rate of 10%, the 10% discount rate that we've taken here. So let's put it on the other side of a board. So we're looking at net present value now. And I said net present value, that's equal to the present value of cash inflows minus present value of cash outflows. So if the cash outflow, the investment is right on day 1, then the present value is the same as the actual value for the investment. Now, if the net present value is greater than or equal to 0, that means let's say the NPV is positive, that means you would accept the project. If NPV is less than 0, that means reject. Now the key thing here is to use the right hurdle rate or the right discount rate. So we're going to have a discount rate here which we call the hurdle rate. So to discount the cash flows, you use the hurdle rate, which is the minimum rate of return that the company is willing to accept on an investment. Now that rate of return may not be less than the cost of capital. It's generally more than the cost of capital. It's the incremental cost of capital for the company. Now generally, if a project is risky, that means let's say the risk on a project is high, then the company would want more returns. The company would be willing to accept only a higher return. So the discount rate would increase. So that would become a risk adjusted discount rate. So it's very simple. As risk increases, you could increase the discount rate. So that becomes a risk adjusted discount rate. So basically, if a project is risky, you'd have a higher hurdle for that project, a higher hurdle rate, discount rate. Now, so what we said was whenever net present value is positive, we want to accept the project because that project is giving us more returns than the hurdle rate, the discount rate that we have set for that project. Now, what if we only have limited funds, limited cash with us, and a lot of alternatives, a lot of options? Then we need to select which are the best alternatives. Basically, this is called capital rationing. We need to decide which projects should we actually invest in. We understand that there are a lot of positive NPVs, but which one is the best? Now, to understand this, we often use Profitability Index. So that is PI. Where the Profitability Index is equal to the present value of the future net cash flows, so the present value of the cash inflows. So let me call it net cash inflows. So this is all after tax. So net cash inflows, and we'll divide it by the initial investment, which helps us calculate the profitability index. So if funds are limited, that means this initial investment, the cash for this is limited. We don't have cash for many projects. We only have cash for some projects. So if this is limited, we would use the profitability index to determine which one of the mutually exclusive projects should be prioritized, which one of them should be accepted. We have net present value on page 16. Right there, cash flows, and put a tick mark because we use cash flows to calculate NPV. Right, time value, put another tick mark because we do consider time value of money to calculate our net present value. Right, simple, and you can put a cross because this method is a little more complicated than the payback period or the accounting rate of return. Now, NPV is the excess of the present value of the cash inflows over outflows, which is discounted using the time value of money. Highlight, discount rate used is known as the hurdle rate of return or cost of the capital. And this highlight represents the minimum rate of return the company is willing to accept on an investment. So the formula for NPV, highlight present value of cash inflows minus present value of cash outflows gives us NPV. So if the NPV is positive or zero, we can accept the project. If it's negative, we should reject the project. Now, NPV has a lot of advantages. So it presents results in dollars which are easily understood. It adjusts for the time value of money. It considers the total profitability of the project. So unlike payback method where it just considered cash flows till the time the initial investment was returned. Now for NPV, it provides a straightforward method of controlling for the risk of competing projects. Highlight, higher risk cash flows can be discounted at a higher interest rate. So if risk increases, increase the discount rate. Second bullet, we're looking at highlight profitability index. And this is right, NPV per dollar invested. Right, used for capital rationing. Highlight the formula, present value of future net cash inflows divided by initial investment. So if we have highlight unlimited or excess funds, we would accept all projects with positive NPV and circle all. But if we have highlight limited funds such that we need to go for capital rationing, we would highlight prioritize acceptance of projects with higher profitability index and underline prioritize. So we've seen that when net present value is greater than zero, that means the net present value number is positive. We're going to accept the project because the present value of cash inflows, that's more than the present value of the cash outflows. We would say that the return from this project is more than the hurdle rate. What if net present value is equal to zero? We would say that at this point, the return from the project is equal to this hurdle rate, this discount rate, or the present value of cash inflows is equal to the present value of cash outflows. We would still accept this project, and the hurdle rate that we have to calculate net present value equals zero. That is the IRR, or the internal rate of return. So guys, once again, internal rate of return or IRR is the discount rate which calculates to NPV of $0, which means it's the discount rate where the present value of cash inflows is equal to the present value of cash outflows. So let's put that on the board there. We're looking at IRR. So this is the internal rate of return. So this is the discount rate at NPV equals $0, or basically discount rate when present value of cash inflows is equal to the present value of cash outflows. So when we said NPV is greater than 0, this would imply that the IRR is more than the discount rate, more than the hurdle rate. We know that when NPV equals 0, that means the IRR is equal to the hurdle rate, because IRR is the discount rate, the hurdle rate at NPV equals 0. So at this point, you could say IRR is equal to the hurdle rate, the discount rate that we've used to calculate NPV. NPV less than 0, that means NPV is negative. Now at this, in this zone, we would say that the IRR is less than the hurdle rate. That means the internal rate of return for the project is less than the hurdle rate that we have set for the project. So this was the case of accept and accept. So both these cases we would accept, same result. So here we accepted, here we accept. In this case we rejected here and we're going to reject here. So let me use the green pen for accept and accept. Let me use the red pen for reject and reject. Let me use the blue pen for this one. NPV equals 0. So this is the point at which IRR is equal to the hurdle rate. So guys, once again, internal rate of return is the discount rate that you've used when you calculate NPV equals 0, or the discount rate that you used where you get the present value of inflows equal to the present value of cash outflows. Now, a couple of quick questions here. When you're doing NPV, do you use cash flows? Yes, we do. Do you use time value? Yes, we do. When you do IRR, do you use cash flows? Yes, we do. Let me just put it here. Do you use time value of money? Yes, we do. We do discounting. So this is just comparing the 4 different techniques. So when we did payback period, we said we'll not use time value. When we did accounting rate of return, we neither used cash flows nor time value. For NPV and IRR, we're using both cash flows and time value. So that's comparison across techniques. Now let's go on the dashboard and look at the numbers again. Try to calculate the IRR from this series of cash flows that we have here. So we said we have an initial investment of $300 with $100 of inflows every year for the next 5 years. Let's say this is all the cash flows that we have from this project. Now, when we did 100 into 3.79, this was at 10%. We got that the net present value is positive, it's greater than 0. But if we use the discount rate of 20%, the present value of annuity for this cash stream is 3.0. So let's do that. So that would be 100 into 3.0, that gives us $300. So at a discount rate of 10%, the present value of these cash flows was $379. At a discount rate of 20%, the present value of these cash flows is $300. Wow, this $300, this is the same as the cash outflow. So guys, this 20%, this is the IRR for this project. So if the discount rate, hurdle rate was 10%, we would say that the net present value is $379 minus $379. So that's a positive NPV. Or the hurdle rate is less than the IRR. IRR is beyond the hurdle rate. It's a good project, accept it. Now, if the hurdle rate was 20%, That helped us calculate the IRR because at that rate NPV was 0. Present value of inflows were equal to the present value of cash outflows. Now guys, if you have a series of even cash flows, I'll give you a formula to calculate IRR, and that formula looks something like the formula you have here for payback period. So let's use the same thing on the other side of the board and then we can come back here. So what's the formula that we had for payback period if we had even cash flows? We said it's initial investment and we're going to divide it by after tax net cash inflows. We'll look at each year. Now in payback period, this gave us number of years. Now in case of IRR, this would give us the present value factor. Now on the example that I had on my dashboard, the initial investment, that was $300. The cash flows each year, guys, note, even cash flow, same cash flow each year was $100. So 300 by 100, that gives us a present value factor of 3. Now what we do is we go to the present value tables and try to find out where do we have this present value factor of 3. And when I actually went to the present value tables, I found that the factor of 3 for this annuity was at a discount rate of 20%. So guys, that is my IRR. So once again, it's the same formula. Okay, first thing, we are looking at even cash flows. Only when it's even cash flows can you do this shortcut method. You don't have to use Microsoft Excel to calculate IRR. So even cash flows, use the same formula as you have here. Initial investment by after tax net cash flows. Instead of talking about number of years, take it the present value factor of 3. Find out where that present value factor of 3 appears in the present value table. We are looking at 5 years of annuity. What's the discount rate at which the present value factor is 3? Your answer for this cash flow, it would be 20%. So 20% is the IRR of this project. So if the hurdle rate is 10%, accept the project. If the hurdle rate is 12%, accept the project. If the hurdle rate is 16%, accept the project because 20% is more than 16. If the hurdle rate is 18%, accept the project. If the hurdle rate is 20%, still accept the project. But if the hurdle rate is 24, 25%, reject. In that case, even your NPV would get negative. So under NPV and under IRR, you're getting the same result. But the problem comes when you have limited capital, when you have to decide which projects you should be investing in. You can't do all the projects, you can do only some of them. Now the issue with IRR in such cases is that it assumes that the company can reinvest the cash inflows from the project at the IRR percentage, which may not be the case. So let's read an example on the book to understand this further. So it says, if IRR on project A is 15%, it's a 5-year project, and project B is 13%, it's a 10-year project, IRR criteria would select project A. It would say project A is better because it's got higher IRR. It's got 15% versus 13% from project B. However, if the cash inflows can only be reinvested by the company at 8%, now the IRR may be high, but the company, they've got the limitations. They are able to reinvest the cash that's coming in only at 8%. Let's say they invest only in bonds. Now in that case, project B may be a better alternative. So guys, you understand the problem with IRR? IRR is good when you're looking at just one project. So it gives the same result as NPV. But when you're trying to compare projects, that's when IRR creates a problem. It assumes that the company can reinvest the cash inflows from the project at IRR. So for project A, it assumes that the company can reinvest the cash inflows at 15%. For project B, it assumes that the company can reinvest the proceeds at 13%. Now that may not be true because in this case, the company can only reinvest the proceeds at 8%. So that is why whenever you're looking at multiple projects, you're looking at limited capital, you're looking at capital rationing, You want to go ahead with net present value, and actually you want to look at the profitability index, which is derived out of net present value. So profitability index is the present value of the net cash inflows divided by the initial investment, because this is your limitation here. You can't take both the projects, you're taking just one out of those many projects or few out of those many projects. So guys, with this, let's get to the book, look at IRR, and we'll come back and do a comprehensive example which will make sure that all this ties in perfectly well. We are looking at the internal rate of return, or IRR. Now IRR is highlight discount rate at which net present value is 0. It is where highlight rate of interest equates the present value of cash outflows and the present value of cash inflows. Right there, cash flows, and put a tick mark because we use cash flows to calculate IRR. Time value, put another tick mark. We use the time value of money. Simple, put a cross because the IRR calculation, that's pretty complex. And look at the formula for IRR. Highlight initial investment divided by after tax net cash inflows. So you could use this formula if the after tax net cash inflows for each of the years is the same number. It's even cash inflows across years. So in our example, if the initial investment was $300 and the after tax net cash inflows for the first 5 years is $100, that gives us circle present value factor and 3. Now to find IRR, we're going to look for present value factor 3 in 5 years row of the present value of annuity table. And there we would find that IRR equals 20%. We're going to compare IRR with highlight hurdle rate and underline accept projects only if the IRR is greater than the hurdle rate, otherwise reject the project. On the last bullet there, underline limitations. Now, one of the major limitations of IRR is that it may not be useful in selecting the best project among a few mutually exclusive projects. Case of capital rationing, as highlight assumes that company can reinvest the cash inflows from a project at the IRR percentage. Turn to page 17. We have the relationship between NPV and IRR here. Put a box around NPV and another box for IRR. Now, if NPV is greater than 0, that means the net present value is positive. This means that the IRR is greater than the discount rate or hurdle rate. Next one, highlight if NPV equals 0, that means IRR is equal to the discount rate. Put a bracket there and write accept. So you accept the project if NPV is 0 or positive. That means IRR is greater than or equal to the discount rate or the hurdle rate. But if NPV is less than 0, that means NPV is negative. That means the IRR is less than the discount or hurdle rate, and we write reject the project. Now we'll look at a comprehensive example on all the capital budgeting techniques that we've learned here. So you have Buddy Company. Now they're considering the purchase of a machine, and the following budget information has been developed to help make a decision. The cost of that machine is $900. So the initial investment that's going out here, that's $900. And then the useful life is 5 years. So you're going to have cash flows for 5 years. Salvage value 0. So terminal value that you have here. So let me rub this off. The terminal disposal price, they're saying this is 0. Then you have depreciation method. They're going to use depreciation straight line method. Annual depreciation is $180 and the annual net cash flow is $250. So let's put it. So we are getting an annual net cash flow of $250 for the next 5 years. So that's 250, 250, 250, 250 and 250 for each of the next 5 years. Now $900 of initial investment, $900 cost of machine, depreciated straight line. So that would mean $180 of depreciation each year. Now guys, what's the accounting income? They've given us cash flows, they've given us depreciation. What's accounting income? So we said accounting income plus depreciation is cash flow, or cash flow minus depreciation is accounting income. So 250 minus 180 would give you accounting income of 70. So that's the earnings after tax that you have for each of the 5 years from this machine. Now they've given you a hurdle rate of return, a present value information. Let's first do accounting rate of return, where we would use this accounting profit. So you have accounting income $70. The average investments, we'll use the initial investment number because that doesn't change, $900. So the accounting rate of return here is 70 divided by 900 gives you 7.78%. Now this method is not using cash flows. It's not using the cash flows of $250 each year. It's using the accounting profit, $70 each year. This method is not considering the time value of money. Now getting back, let's now look at the payback period. So we're getting $250 for payback period. We're going to use cash flows, not time value, but we're going to use cash flows. So we're getting $250 in year 1, $250 in year 2, $250 in year 3. So 250 plus 250, 500, 750, not yet recovered. 1,000 more than recovered. So it'll be somewhere between year 3 and year 4. Simple, let's use the formula. So we're not doing discounted payback for this. Let's just do simple payback right now. So payback period, you'll have initial investment, $900. What's cash flow each period? It's the same number, so we can use the formula, $250. What's the number of years? 3.6 years. So the payback period for this machine would be 3.6 years. So it's after 3.6 years that we would recover the initial investment. Now let's look at calculating the net present value. So it says the hurdle rate of return, the discount rate that we're going to use for net present value is 10%. So we're going to have present value of cash inflows and the present value of cash outflows. So present value of cash inflows, we're going to be looking at all these cash inflows. What's the present value? So at hurdle rate of 10%, the present value factor for this annuity is 3.79. So 250, so it's an annuity into 3.79 gives us present value of cash inflows of $948. What's the present value of cash outflows? So all that $900 is going on day 1. So the present value of $900 on day 1 is $900. So present value of cash inflows, 948. Cash outflows, 900. What's the net present value? 948 minus 900, $48. So let's put it on a board there. So we got present value of net cash inflows, that's $948. Present value of cash outflows, that's $900. So what's the net present value? That's $48. Is the net present value positive? Yes, it is. Accept the project. Go ahead with purchasing the machine. It's a good capital budgeting technique. Now, so this was net present value. Let's do profitability index. So profitability index is present value of net cash inflows. What's the present value of net cash inflows? 948. What's the initial investment? That's $900. So the profitability index is 1.05. So that's more than 100%, it's good. But if we had multiple investment opportunities, then we would have looked at profitability index to compare, to prioritize which opportunity, which alternative should we go for first and which would be later priorities. Now, so we're done with payback period, we've done accounting rate of return, net present value, we've done profitability index, that's an extension of net present value. Now, let's do IRR, or the internal rate of return. Now, it's a single stream of cash flows, even cash flows. So we could use this formula that we had for payback also for IRR. So let's do that. So the initial investment number that you have here is $900. The after tax net cash flow each year is 250. Guys, 900 by 250. This is the same as what you have for payback here. 900 by 250. Here you get 3.6 years. There you get 3.6 present value factor. Now you got to find this 3.6 present value factor on the present value table. So I'll look at the present value table that we have here, and I can see factor of 3.6 at a discount rate of 12%. Guys, I can say that at this present value factor, the IRR of this project is equal to 12%. Question: is the IRR more than, equal to, or less than the hurdle rate? Hurdle rate was 10%. So IRR is 12%, hurdle rate is 10%. This is more than the hurdle rate, accept. You got the same result here. We said NPV greater than 0, it's $48. Accept. So same result. Because IRR, or the internal rate of return that this project was generating, was more than the hurdle rate that the management had set for this project. So guys, calculating internal rate of return could be very simple if you have single stream of cash flows. If it's uneven stream of cash flows, it's really difficult to do it manually. You use Microsoft Excel for that. So guys, this is all about capital budgeting, and I'm sure you guys had a lot of fun on this. Let's quickly recap on all the capital budgeting techniques on page 11. So we've looked at 4 techniques. The first one, highlight payback period. That's equal to investment divided by annual cash flows. And the result is put a circle around number of years. You could use this formula if it's the same, it's even cash flows coming in across years. The next technique, accounting rate of return, that's accounting income divided by average investment. That's basically the return on investment. Third one, highlight internal rate of return, or IRR. And the formula here is pretty similar to the payback period formula, which you could use if there's a stream of even cash flows. So highlight investment divided by annual cash flows. But the result here is put a circle around present value factor. So we need to find this present value factor on the present value of an annuity table to get the IRR percentage. Then you have net present value, which is the present value of cash inflows less the present value of cash outflows. Turn to page 18, where we have our comprehensive example on capital budgeting. So first we're looking at highlight accounting rate of return, which is accounting income divided by investment. So highlight $250 minus $180 divided by $900. So $250, that was the cash flow. $180, that was depreciation. So $250 less $180, that gives us accounting income of $70. We're going to divide it by the investment amount, $900, which gives us accounting rate of return of 7.78%. Next, highlight payback period. We'll be looking at investment divided by the annual cash inflow. So highlight $900 divided by $250 equals 3.6 years. Next, we'll calculate, highlight net present value. And here we have a hurdle rate of return of 10%. So on the present value table that you have there, highlight 10% and write there hurdle rate. Highlight inflows, cash of $250 coming in every year for the next 5 years. The present value factor is 3.79. The present value of cash inflows is $948. Outflows are all happening at day one. So the present value of $900 of outflow is $900. Next, highlight NPV, or the net present value, is present value of cash inflows less present value of cash outflows, which gives us, highlight, $48. Next, highlight profitability index. So that is the present value of cash inflows divided by the investment amount. So highlight $948 divided by $900 gives us 1.05. And then we have the calculation for, highlight, internal rate of return. Now this is the rate at which the present value of the annual cash inflows of $250 equals the investment of $900. And this occurs when the present value factor for the annuity is, highlight, $900 divided by $250. So this is the same formula as we had for the payback period, just that the resultant 3.6 is a present value factor. So circle 3.6 and let's find 3.6 on the present value of annuity table that we have. So we can see at 12%, the present value factor on the ordinary annuity table is 3.6. So circle 3.6 on the present value of ordinary annuity table and draw an arrow. Highlight 12%, write IRR. So the 12% rate, that's the internal rate of return for this project. So once again, internal rate of return, that's the rate at which the present value of the annual cash inflows of $250 equals the investment of $900. And this occurs when the present value factor for the annuity is 3.6 at, highlight, 12%. So if you look at the calculations there, inflows $250 for the next 5 years, the present value factor at 12% is 3.6. The present value of cash inflows at 12% discount rate is $900. Outflows is $900. NPV equals 0. So right there, if IRR equals hurdle rate, NPV equals $0.